Oh, she's doing it there.
Hi, Tia.
Thank you, Tia. So we are live now. So we will bring this meeting to order.
Thank you so much.
Oh, no problem, Jim. And then first step, why don't we go around the room and introduce ourselves, and then we can proceed with the PNC presentation. I'll go first. Craig Sherman. I am the head of finance with the Park Board.
John Dyer, member of the investment committee. Terry Alban with PNC.
John Camello, Regional Investment Director with PNC.
Steve Schott, PNC. Jason Barron, Parks.
Scott King, investment member.
And then we have online Steve and Jim, both with the investment committee. And let us know, Steve and Jim, if you can hear us well, because this is going through the laptop. This isn't going through our traditional, what we use for board meetings.
I was able to hear everybody, Craig.
Wonderful. Thank you.
As
So
was I, Craig. So thank you.
wonderful to hear. Okay, so we will go ahead and turn it over to the PNC team here and go through their presentation.
Thank you very much. And thanks for having us this afternoon. We still good with 20, 30 minutes?
Yes.
Okay, very good. I'm going to, we'll talk briefly, taking stock of the markets, kind of what happened in 22, what we see moving forward, just from a market economic standpoint. Briefly touch on the investment policy, but then get right into the portfolio performance and what occurred in 22, how that kind of played out. And as we kind of go through the market information, we'll hit some of those points that'll come back as we get into the investment section. So I'm going to scroll forward to slide 4. And this is a look at kind of what were or our thoughts as far as different asset classes as we look forward into 2023. You know, equities, fixed income. We're not going to talk too much about alternatives, but do we like them? Don't we like them? Where that is. And you see both equities and fixed income, the orange dot is squarely in the middle. Equities, we still think in comparison to other asset classes have benefits and some potential. They've gotten off to a great start this year. But again, earnings and earnings expectations are starting to come down. We do believe we will see a recession, albeit a short and not particularly deep one this year, probably late second quarter, somewhere around that time. We've seen leading indicators start to drop, et cetera. So equities most likely would pull back in something like that. But as we were just talking about, they're off to a phenomenal start to the year. And the markets do seem to want to go up. And part of that is it's rare to see equity markets negative 2 years in a row. It happens, but after a rough year last year, we would expect a bounce back. We're seeing that now, but if earnings deteriorate, that's going to be a headwind. But wouldn't be surprised to see things pick back up in the second half of the year as well. Fixed income, interesting story. Since the Great Recession, fixed income has not been an area we were very excited about. Primarily, it's a good place to, except in 2022, when stock markets drop, usually fixed income will help add some ballast to the portfolio. Did very little of that in 22. You had that rare year where both fixed income and equities were both negative for the year. That being said, interest rates have now risen higher than they've been in 15 years. That gives bonds some potential over the next few years, either at the rate they're at, they're yielding better, or if you were to see, and we don't expect rates to come down anytime in the near future, but maybe 9 months out, 12 months out, if you see rates pull back in a little bit, that's going to make bond prices go up. So it's now a lot more interesting as an asset class than we've seen in a long time. Good, bad, and ugly, a page we have in here that I may just brush on a couple items. There are fewer items on here than we've had in the past and fewer in the good column. Historically, we've been able to balance out the good and the bad pretty well, but right now, China ending their COVID restrictions, helping get the supply chains back in order is a tremendous positive and probably is assisting getting some of the inflation numbers down as much as anything. Our U.S. labor market continues to be strong. There are more job openings than people looking for work. It's hard to get inflation down when that dynamic is in place, but the Fed is going to soldier on. And then, equity valuations after dropping significantly last year are looking better priced than they have historically. So the question is, will earnings support that? From the bad perspective, the couple things, little blue arrow, longer for longer monetary policy. The Fed is being very clear. They will not lower rates until they see inflation much, much closer to their 2% target or well on its way. So that's where we get into the conundrum of this year as growth starts to drag. If inflation's still running 4%, 4.25%, 3.75%, I don't think we expect the Fed to start lowering rates to try to help things out. However, if you see inflation get down closer to 3%, maybe 2.75%, I would assume that they may look to lower if GDP is clearly in negative territory. So how that plays itself out is going to be the story of the first half of the year. That's a lot of things. I don't know if there's anything in here you wanted to draw out or anything else, just kind of on the broad landscape.
No, I mean, some of the key themes that impacted markets in general over the course of last year are still with us. I think we have started out, and you can even see in the returns for the fourth quarter, we saw a rebound in more risk-oriented assets doing well. And that's obviously extended so far into this year. A little bit concerned, markets may be getting a little bit ahead of themselves, anticipating inflation kind of falling in the Fed, maybe taking its foot off the brakes a little bit sooner. The Fed's expectations for rate increases is still a little bit higher than what markets are pricing in right now. So there's somewhat of a disconnect. There's also a disconnect between when the market expects the Fed to ease relative to what the Fed has been saying. And so if the market does get that wrong, or if they're off kilter, you could see some volatility, and wouldn't be surprised to see some continued volatility here in the first half of the year. Expectations that once we get to that terminal rate for Fed funds, that markets probably would start to pick up some steam. So a little bit concerned we may be getting a little bit ahead of ourselves at this point.
Guys, this is Jim. Can you hear me?
Yep.
Yeah.
Okay, I just had a question. Given the way the bond market is looking at this point in time, is this an area that you would recommend maybe over weighting a little bit in bonds at this point in time, or what are you thinking?
Great question. I think right now, because of the uncertainty of when we will get a Fed pause, we're pretty much equal weighting. Whatever your particular benchmark is, and you all have a very specific benchmark, and we are weighted pretty much right on the screws of the equity fixed income line. And that's where we're comfortable. Now, that being said, as the Fed gets closer to what we think finishes up, you might see that. I don't know that we'll eventually overweight fixed income, but certainly we don't want it to be underweight right now.
You might talk a little. You might talk a little bit about that because, if we're equal weighted, if we're right on the benchmark, there's that's something we could do as a committee, and I'm not saying this to be nasty, but at what point do you and your financial advisors take a look and say, hey, we think this is where it's heading, not wait and see till it happens to then make a move, but sort of say, this is where we think it's heading, and would advise to do this to take advantage of the market?
Yeah, that's, again, another very good question. And one of the, one of the things we try to do is look ahead, and we'll hit on some of the, items we believe. And as we mentioned, we think second quarter, we'll be looking more at a significant slowdown to the point where we see GDP slow down. And hence our fixed income positioning is higher currently than it's been. I don't know, or I guess what I would say is, until we see a little more clarity in the indicators that we follow that are ahead of where actual interest rates and bond prices are, at that point, we would try to get ahead of it a little bit. Does that make sense?
Yeah, that's fair.
But it is a good point. You don't want to be reactionary in our role. And reality is sometimes items, and really at the beginning of 22, the Federal Reserve shifted policy very quickly. And we'll be talking about that kind of at length here. But that was something you really can't prepare for. Other things like a slowdown, you can. So it is, we'll be taking a good look over the next month or so and watching the data to try to stay ahead of that.
Great. Thank you.
You're welcome. Look here, we're on page 6. We will pick it up a little bit here, but just here we look a little bit more closely, and this kind of talks a little bit about what we're just talking about. Our process is to follow the business cycle, and we believe by understanding where you are in the business cycle and where the cycle is going, you can position yourself in the best way. And we do see things slowing down. So the big question is, will the Fed engineer a soft landing? Maybe we don't have that GDP turn negative this year if inflation falls fast enough. But that's pretty compressed right now, happening within the next 3 or 4 months. Usually we've been waiting as Fed has been raising interest rates dramatically at 75 basis points a clip for several months. And they've slowed it down to 25, and we are seeing inflation start to come down. So, a little more comfort if we see inflation come down again on the next reading. But those types of things can reverse fairly quickly. So that's kind of where we are. But valuations in equity markets are kind of the story. They look better. But for that to continue, and right now we're in the middle of earnings season, and it's not nearly as strong as the past couple quarters of earnings, and we're seeing projections and companies start to give lower forward guidance. So again, that's more of the forward looking information that gives us pause there a little bit. I don't know if you had
no, I mean, I think our expectations right now are that markets in general would be a little bit choppy. We think some of the underlying fundamentals from both an economic as well as from, say, an earnings perspective are looking relatively weak. And that's somewhat of a disconnect from what we've seen so far this year from equity prices in general kind of moving higher in risk assets in general. Even if you look more closely at fixed income assets, say higher yielding assets, they've started the year off pretty strong. Our expectation, from a business cycle perspective, we think we're kind of at the tail end of that slowing expansion phase and right on the cusp of maybe going into a recession. And so as we think about our broad asset allocation, Jim, we probably are a little bit closer to our primary targets, a little bit higher cash allocation. But from a fixed income and a cash perspective, holding a little bit of cash on hand, given where short-term rates are, is not a bad thing. You're getting paid at this point in time to at least maintain a modest overweight towards cash. And that gives us some dry powder when we start to see opportunities present themselves to maybe reinvest that back in on either the fixed income side or the equity side. So, I mean, expectations right now as we look at the business cycle, I think we're on the cusp of going back into, a contractionary phase. Again, most likely mild. We don't think it's going to last long. And what we could see is equity markets and more risk-oriented markets sell off a little bit and then potentially do more of a V-shaped type recovery. It's been a very interesting start to the year, though. If you look at how markets have reacted, again, getting back to my earlier point, we think they may be getting ahead of themselves, just with regards to inflation and what the Fed may do and how aggressive the Fed may be for the next couple of months here. A little bit of a disconnect from what the Fed is saying and what markets are anticipating. So in short, expecting some continued volatility with probably better outcomes as we anticipate or move into the second half of 2023.
And with that, page 7 provides a little bit of a visual depiction of that, where we think we are in the business cycle. Also at the bottom of the page gives you a view of some of the leading indicators that the conference board utilizes. And it's about 50-50 or 60-40 right now, with leading indicators worsening. And page 8, I won't spend a ton of time here, but cash is, as of yesterday, paying 4 to 4 1/4. Today, that's gone up a little bit more with the Fed raising the short-term rates. So we would expect closer to 4 1/4 to 4 1/2 coming up soon.
Just a quick question. When it says unemployment claim is improving, does improving mean that they're going up? So more people are unemployed, and that's good for
No,
the market?
unemployment claims improving means they're coming down, and I believe, yeah.
So low unemployment is still good.
Yes.
Okay.
That's part of a little bit of a conundrum. Like the Fed is hoping that you start to see some weakness baked into the job market. We're seeing that kind of slow.
It's ironic.
Yes, yeah.
People are making more money, which is why they're spending more money. Should be a good thing.
Right. Well, too much money chasing too few goods, the old Milton Friedman line, and really kind of what we've been seeing the last year and a half. So they're trying to suck some of that money out, and they've done it. If you look at the data for the money supply, it's dropped pretty dramatically in the last year. And now we just need demand to slow down just a little bit.
The impact of the rate increases that we've seen, in particular in the second half of last year, haven't necessarily fully made their way into the overall economy. So, I mean, we're still anticipating some of that impact to help kind of slow things down and cool inflation. And so some of that's not necessarily reflected in, say, the job market just yet.
And just quickly, page 9 shows, we can look at the last 10 years or 10, 14 years of where the different asset classes have performed. And, it's been a long time. If there's even a period in there when not a single asset class was above the line, like last year. Large cap value was the best performing sector at -5. And then high yield, et cetera, with large cap growth finishing the year down 29, which was, a difficult area. And the next couple pages bear that out as well, which is index returns over the year. The S&P 500 was down 18%. And the Bloomberg Barclays Ag, the core bond index that our industry uses, down 13%, which is about as low as I think it's certainly in the last 15 years. All of that being said, I'm going to scroll forward so we can move into the presentation. I'm assuming that no changes to the policy statement to discuss today. I don't have any. So page 22, the beginning of the portfolio review, just a couple manager changes throughout 2022. Back in February, as the year got started, we made adjustments once the Federal Reserve made it clear they did a 180 and decided to become extremely aggressive in their tightening cycle. We added Lazard Concentrated to the large cap core space and pulled out Wisdom Tree Dividend Growth. During that rebalance at that point in time, we also evened out our growth versus value split. We were overweight growth throughout 2021, which allowed us to perform quite well that year. Started off the year okay, but once that change happened, there was a pretty dramatic shift to value. We went kind of even down the middle at that point and had a decent performance after March of 22. We also, throughout the year, we added BlackRock Strategic Income in June. As volatile as equity markets were in 2022, bond markets were every bit as volatile throughout the year. We made the determination that instead of us trying to decide which bond manager fit this particular cycle in the market, an unconstrained manager or an additional unconstrained manager, we already had PIMCO managing an unconstrained component of the funds. They could adjust whether it would be mortgage-backed securities, higher yielding or more credit-based or higher quality, whatever the appropriate fixed income allocation at that point in time. Moving forward, we thought they were a little more nimble in doing that. So we increased that component of fixed income. We also, later in the year, we had two emerging market managers. We decided we could lower fees a little bit. Didn't need two managers with small slices. We got a core emerging market manager in RBC and made that adjustment as well. So some of the changes to the actual portfolio managers there. On page 23, you get a view of where we are allocated between equity and fixed income. And right now, pretty close at about 69% equity versus the 70% target. Fixed income, we tend to look at fixed income and the cash portion together. So we are a little bit overweight there if you add cash to fixed income at the moment. And then the equity asset allocation as of the end of the year, you can see on the far right, large cap core, 17%. We are equally weighted between growth and value. And really in the mid and small cap, we have focused and concentrated in the core section there as well. Probably a little bit underweight on the international right now, but not too far off. And then page 25, looking at fixed income, we keep this portfolio in a core type allocation. The bulk of the assets are straight and core with a couple unconstrained managers. There is one passive ETF in there, the iShares 7 to 10 year Treasury bond ETF. Typically to make sure we have a high quality Treasury position in the portfolio. Ultimately, it's the safest position in the portfolio, but certainly impacted dramatically by interest rate increases and had a difficult year in 22. Pages 26 and 7, similar information that we just covered, broken down in a little more of a line format. So we'll hit investment performance on page 29. Focus mostly on the 1 year since we got the full year in there. You know, I'll just say the fourth quarter ended up being positive across the board and performance was not bad. Actually pretty solid on the equity side, outperforming the equity benchmarks. As we look at the 1 year, total net performance was negative 17.55%. The Bettman primary benchmark was down minus 15.79. So quite a bit of underneath the benchmark in 22. We look at the style blend, closer to that from a performance standpoint. That just tells us that the individual managers actually performed pretty decently. It was an allocation issue. Looking at the equity sleeve, down 18.41%.
Could you explain
Yes.
that just a little bit more?
Say that again.
Could you explain that last point?
Yeah, the blended
Which
benchmarks.
is what I was looking at. I apologize. I was trying to follow along. I thought I had it. I lost it.
Yeah,
What's
no
on
problem.
page 29?
Yeah, page 29. The style blended benchmark is one that the computer generates. It looks at the actual allocations that are in the portfolio, whether it be 20% in the large cap core fund, and it pairs up a benchmark with that. And what it tells you is how did the managers perform compared to their benchmarks as a
So
group.
their benchmark was 1702, and they
Uh,
actually hit negative 1579.
The portfolio was negative 17.55, so they were a bit under their total blended benchmark. But
And the blended benchmark is 1702.
yes,
Okay.
and on the equity side, again, the equity managers were down 18.41 versus the Bettman benchmark of 18.14. So they underperformed the benchmark there. Again, versus their individual benchmarks evened out. They outperformed by about 140 basis points there. So that just tells us the managers are performing pretty well. That allocation, we were overweight large cap growth coming into the year is the bulk of the underperformance. So we'll look at that on the next page here in a minute. Fixed income, again, a lot of underperformance in the total fixed income category, minus 14.52 versus the Bloomberg Barclays Ag, which was down 13%. And in that case, we had a couple, the treasury position, while it's very safe and secure position, it's very interest rate sensitive and struggled last year, as well as one of the managers, Western Asset Core Plus. And Core Plus is 90% investment grade with 10% high yield added on. And those typically perform nicely in stagnant bond markets, but in a market that was as volatile as last year, it took its lumps. Yeah, I'm sorry.
No, I mean, if you think about it, I think it's highlighted well, I guess, on page 30. We're making two primary decisions when we're constructing the portfolio: the asset allocation decisions, as well as the manager selection decisions. And as we look over 2022, those asset allocation decisions, which are, some of which are highlighted on page 30, that really drove that negative performance. Our manager selection overall was also modestly negative, but a lot of that was on the fixed income side. Our equity manager selection added value. Overall, the fixed income manager mix detracted a little bit as well. So, I don't know, Terry, if you want to kind of talk about it.
Yeah, and just to kind of bring it home here on page 30, as we came into 22, and that's one thing, we always have a tendency to get focused on calendar dates. The economy and the business cycle don't necessarily hold to those real clear. There is some items that tend to happen towards the end of the year, but nonetheless, if we look back to 21, we actually had a nice year in 21. We were up 13.94% net of fees, outperformed the benchmark by 45 basis points. But a large part of that was our overweight, which is actually should be say tactical overweight to U.S. large growth here. It says strategic, but that had been a positioning that had been in place since the June of 2020, and it really allowed us to perform well. If you look at the growth versus value in 21, growth outperformed value by 7%, 8% on the year. If you look at the two different sides via the S&P 500 growth and value, 22 That dramatically changed where growth was down almost 30%, value only 5%. So we got quite a bit of reversal. The trailing 3 years, again, growth had outperformed value by about 14%. Sometimes you can look ahead and see potential for reversal, but when it's a macro Fed-driven policy change, that's a little more difficult to adjust to. We are, as I mentioned, about equal weight between the two at the moment. Overall, we were down, 176 basis points, 1.76%. 46 basis points of that were fees. So what were the rest? Well, as we look, we trailed 101 basis points after Q1. And that's when we, through February, we were overweight growth. We made that adjustment where we equal weighted growth and value and only trailed 30 basis points for the final 9 months of the year. So we got a bit of that corrected. And as John was saying, we make two main decisions, allocation and manager selection. And allocation contributed 123 basis points to the underperformance versus the managers did quite well at -7. And a couple of those managers to kind of highlight in the large cap value space, Delaware is a relative value manager. They were about 5.2% above their benchmark. AB Concentrated, we've had both of these managers in the portfolio for a while now, but AB Growth was up 5.4% over its benchmark. So we really like the managers, and we feel high quality managers are exactly where you want to be right now. In 2020, the market was led by companies that had no earnings. And that was a difficult environment to trail in because we had some higher quality managers. We made some adjustments to that, but in 22, especially towards the end and coming into this year, we're seeing higher quality managers do pretty well. And that's where the bulk of the assets are. The information lower on the page just gives you an idea how 22 played out between growth and value. Try not to belabor that, but any additional questions to performance in 22 and how that played out? Okay. One thing, certainly the next couple pages show you the individual managers, how they did versus their benchmarks. I won't go through each and every one. Page 34 gives you kind of a 5-year look back at how performance net flows into and out of the portfolio. And I think as of yesterday, we were a little under 2.4 million. So being around 2.25 at the end of the year, we've had a nice lift here at the beginning of the year. Page 37 in the appendix, a fee analysis. And this is a forward-looking, where are we now as far as fees in the portfolio based on the balances in each of the managers as of December 31st. Our advisory fee is right at 50 basis points, and the total investment manager fee is 25, bringing the average, those two combined to 75 basis points. That's a few basis points lower than we anticipated for 22, given some of the emerging market manager changes, et cetera.
It's the best clarity on fees that I've seen in any presentation. So I don't know if this is new, or if it's not new and I missed it previously, I apologize, but I think there is perfect clarity in that. Thank you for providing.
You're welcome. We've been doing it this way for a while now, but that's exactly.
Shame on me for not noticing.
Well, it's all right.
I noticed it went down.
Yeah.
Yeah. But again, it's important to realize this is kind of a forward-looking estimate, but I was working with another client yesterday and we were comparing it. It's pretty close to what we saw last year for there. So it gives you a good view. With that, any questions we can answer?
Any questions, Jim, Steve, Kevin?
No, I think this is Jim again. I think just as my last question, are you recommending, do you see anything that you will significantly change in this coming year? Should we be reevaluating any of our investment strategy assumptions that we're making? What would you recommend to us at this point?
Yeah, I think your investment policy provides us quite a bit of bandwidth to adjust as conditions adjust. So I don't see anything happening in the capital markets that would make me say, gosh, we need to add this or something to the policy. I think you hit the nail on the head talking about fixed income. It's a much more attractive asset class than it's been. But for the next 2 months or so, the Federal Reserve is certainly going to hike rates one more time. So I think we'd be a little early to consider that, overweighting that, but that could be coming down the pike. And we've got the bandwidth to do that as needed. We're certainly going to be evaluating the managers as always. Western Asset Corp Plus in particular had a real disappointing year. The treasuries didn't perform, but we like that position in the portfolio and feel good about it going forward. I don't see us making any dramatic change at the moment, but as we get closer to the end of the tightening cycle, that's when we could make some adjustments.
Yeah,
Okay.
Jim, maybe a couple of comments to add on to that. So, think about where we are from a business cycle perspective and valuations. From an equity standpoint, Terry's right. Short term would anticipate some continued volatility. Most of that stemming from uncertainty in the direction of some macro related events. But our expectation is that we would be facing somewhat of a mild recession and potentially more of a V-shaped recovery as we move into the second half of the year. As we go through that contractionary phase and come out into more of an expansionary phase or trying to get in front of that, you could see potentially a little bit more passive exposure being implemented into the equity side, in particular that domestic large cap space, and complement that with potential tactical trades depending upon how our outlook evolves. And on the fixed income side, the opportunity set there has improved. And again, shorter term, feel pretty comfortable with where we are right now. That emphasis on some unconstrained managers that are very nimble and could put money to work where they see opportunities more immediately. But as we move into this year and as we get to that terminal rate, could anticipate seeing, if we are facing a mild recession, a continued improvement in underlying credit quality, maybe extending out from a duration perspective as well. And so those are some potential changes that you could see maybe influencing the structure of the portfolio as we kind of move deeper into this year.
Gotcha.
Hi, this is Scott. I want to try and see if I'm understanding this correctly. Kind of regurgitate back to you in my words. Jim is asking about should we go for more fixed income because interest rates are going higher, and okay, we want to be able to buy the bonds while the interest rates are high. While at the same time, on page 9, you guys are kind of saying, if we go more into fixed income and out of equities, we may potentially miss a good market rebound. Now, I know history doesn't always mean what happens in the past is going to repeat, but there's pretty good evidence, or there's pretty good gut feeling that the equities could have a really good year, and we don't want to miss out on that as well. Is that kind of what I'm feeling, or?
Yeah, I mean, in near term, we would anticipate some continued volatility, maybe both on the equity and the fixed income side. But to your point, longer term, and if you turn to page 10, and just use this as a reference real quick, on the far right-hand side of page 10, you will get our capital market assumptions. These are forecasted rates of returns for both equity and fixed income you see the returns, you also see the level of volatility. So just, at the top of page 10, look at the S&P 500. So we would forecast an average rate of return of roughly a little over 7% for an asset class like the S&P 500 over the next 10 years. But you'll notice right next to that is a measure of volatility or standard deviation. It's a lot higher. If you scroll to the next page, page 11, and you find that Bloomberg US aggregate or that core bond, it's still towards the top. We would anticipate a broad-based investment grade bond, portfolio similar to, say, the US aggregate earning 3.7%. But notice the volatility of that is a lot lower. So while the rates of return or the anticipated rates of return on fixed income have definitely improved over the last year, just given what the Fed has done in raising short-term rates, we're still anticipating that we get a better rate of return staying in equities over that longer-term period. It could be very volatile though short-term. And so right now, there is still some uncertainty where you're at a point where you're changing phases of the business cycle. And so when you start changing business cycle phases, there tends to be spot volatility. And so we have been playing it a little bit tight to the vest, but would anticipate as we get a little bit more clarity, making some additional changes, whether it be in the equity side or the fixed income side, and the underneath components of both of those pieces. Does that help?
Yes, yes, it does.
Great. Any other questions? Well, thank you
I'm-
very much for the presentation. Yes, Jim?
No, I was just going to say the same thing, Craig. Thank these guys for coming in. It was a very good overview, and appreciate your help on this.
Thank you. Our pleasure.
Meetings were easier to do in 2021. Huh?
Yeah, let's hope so, right?
If you get everybody together.
Yep, that's true. Yeah.
Well, thank you again.
Thank you. Thank you very much.
And we'll take a quick little pause here, then we'll continue on with the meeting.
How's Florida, Jim?
Florida is wonderful. Compared to what I think I would be experiencing up there, I'm glad I'm here.
You in Fort Lauderdale, Jim?
I am in Fort Lauderdale.
You have to undo the video. Yeah, I'm gonna do that right now.
I think it was about 14 degrees
Okay,
when I
yeah,
left
Scott
my
and I
house
did it.
this morning.
That's okay.
That's it. So we're gonna have you guys at least see two of us. How about that?
Okay, they know what
So we'll go ahead and continue on. Can you hear us? I had to put the laptop a little far away.
Yeah, I can hear you.
Wonderful. Okay, let's continue on. The next step is the approval of the November 16th, 2022 minutes.
Is this where I say motion to
Yes.
approve?
Yep.
Did Scott make a motion?
Yes, Scott made a motion to approve the minutes.
I'll second that emotion.
Okay. All in favor?
Aye.
Aye.
They look great. Aye.
Aye.
Thank you. And then we'll move on now to the Q4 2022 performance. We'll walk through that real quick, and then I also want to kind of point out when we get to P&C why the 3-year doesn't really line up with the benchmark. So we're fully understand because Scott, there's a change that occurred in there that isn't showing the value in the 3 years. So I'll go over that. But we'll start with the US Bank. So US Bank, when you look at each of the funds, they were off the benchmark a little bit, not much, only 7 basis points. Right. No, 5 basis points. I don't know where my math is today. Then you look at the year to date, they're pretty in line, just off a little bit from the benchmark. Then their 3-year is just off a little bit as well. So you'll see is 6.68 for 6 months, year to date 15.95, and 3-year 3.48, 5-year 4.32.
And the benchmarks are where?
The benchmarks are the amounts that are provided. It's a combination of the equity and the fixed income based on different
So if I'm looking at
indexes.
the line, total US Bank, right? That's
Yes.
and then what am I comparing those to?
So each of the lines, like the Drabner, what we're looking at is like for say the 3 months, the performance was 6.68, and the benchmark based on the indexes was 6.83.
I got you.
Yeah.
Okay.
So yeah, not for the total, even though
But I guess they are actually all the same.
it would be the same. Yeah, because
Gotcha.
each of them are the same benchmark.
Would weigh out the same.
Yep.
So the benchmark was a little better than what they performed, but not too much.
Yeah, which is very common when it comes to US Bank, Fifth Third Bank, and PNC. And then when you move down to Ball and Gainer, reminder Ball and Gainer is a dividend driven investment. That's why they are different. They have a lot more in equity as well with the S&P, and they perform extremely well the last 3 months, last quarter at 9.66 with a benchmark of 6.42. Their year to date, they're at 8.89 with benchmark of 15.97. 3-year is at 7.30 and the benchmark is 6.14. 5-year, they're performing very well at 9.65 with a benchmark of 7.91. So
It's a
they're
baller business.
yeah, they've been performing extremely well ever since I've joined. But they
Well,
have
and
a
I think-
different.
And I think it's important that we are intentional and we talk about this at least on an annual basis. And that's where we are being a little more aggressive overall because we do have with having Ball and Gainer in our portfolio. And I think based on the size of our portfolio, I continue to be comfortable with having, because that's with $4 million, that's a significant investment with Ball and Gainer in a riskier stock. I mean, they do have they're a specific sector driven stock. I mean, manager. But I think when you look at what it's done for us over the past several years, it gives me comfort keeping that large investment with them. I think if we had a smaller overall endowment package that we were looking at, we may not be so inclined to have a large percentage with Ball and Gainer, but obviously they've done very well for us over time. And that holds true. You know, equities do over time perform better than fixed income. And I think as long as we continue to discuss it, at least annually, and agree that we will continue with that position, I think we're fine doing so. But I just thought I'd open that up and let everybody else chime in to make sure that we are in agreement on that.
Well, say since I joined the investment committee, you know, Ball and Gainer never makes excuses when they come in for presentations. They never, it seems like PNC, every time we have them come in, they make excuses for underperforming. They're picking the benchmarks and they're underperforming their benchmarks. Ball and Gainer, I think there was one quarter where, because they were growth and income, it didn't perform as well as it could have. But other than that, they're just a solid investment. I wouldn't want to have all 20 million in Ball and Gainer, but I do like them.
I agree. I think very highly of them. I think very highly of Jim Russell. And remember when they did make that presentation that they had a relatively soft quarter or year, Jim kind of explained that's what's going to happen with their portfolio of high quality dividend yielding stocks. In a great year, they might be slightly below the highest performers. And in a down year, they're not going to go down as far as some of the others that struggled as they did in 22. I think we're at a decent number with them. I'm very comfortable with their portion of the portfolio. I'd be comfortable with a little bit more. They always seem to impress me. And I would agree with Kevin about PNC.
Yeah. John, how are you feeling at this point about Ball and Gainer?
It is tempting to look at it just on the benchmark to actual basis, and it kind of makes sense to do so. But I think really, as Steve indicated at the end, we do ask them to do a different thing. I don't think they have necessarily a different IPS, but I expect different results because they have different direction. As an entrepreneur whose nature is not to say damn the torpedoes, but to say what there were torpedoes afterwards, I'd be 100% Ball and Gainer. But as a steward of an institutional class of asset, I think we are required by certain structural things to be diversified with different managers anyway. But that being the case, I think you're going to send roughly 20%, a little less than that, of our, a little more than that rather, excuse me, of our assets are charged with being a little riskier and are acceptable to have a more volatile return. But in the mix, I think that's probably globally the right play. I don't know if it's mine or this committee's to say it should be 23% or 28% or 30%, but these are the commissioner funds. But as an advisor in that capacity, I'm comfortable. And while I would love to have those performances across the portfolio, I think we wouldn't get those because we're structurally not able to get those. So I think we enjoy them while we have them, but understand that our charge is balance and measured risk and move that direction.
Yeah, I fully agree with you, John. And that's where I do think it's important, because we are charged as a committee with managing these funds for the commissioners. So we would make the decision if we would decide, well, absolutely, they would have to vote on it. But I think the commissioners do look to us to recommend how we're investing these funds. And that's why, just because of the nature of Ball and Gainer, I just wanted to get everybody's opinion out and make sure that we're still comfortable, because it is a more riskier asset base that we've got. But I agree with all of you. I am very comfortable with having 20% with them. I do think that from our manager groups, we will get a straight shot from them. And I think I like their approach with it is what it is, and typically no excuses. So good. Well, I just wanted us to have that discussion. And I feel good that we're going to remain that way with this portfolio.
Great. Thank you, everybody. We'll move on to PNC. They provided us the presentation. Just to kind of recap how they're performing. You'll notice the 3-month was 6.59. The year to date was negative 17.55. This is the one, Scott, I want to point out. You'll notice the 3-year is 1.06 with the benchmark around 3.28.
Yeah.
That's because they didn't change the IPS. And right now, when you look at that figure, I believe, is it, Jim, 1.5 or 2 years is with the new IPS, and then that 3rd year is from an old IPS, and that they weren't performing very well.
Yeah.
Okay.
You know, and just gut reaction to the presentation that we have. You know, when we look at their year overall, did they kill us? No. Did they underperform? Yeah, they continue to underperform. Did they have excuses? Yeah, there's excuses. At the end of the day, they're the ones who are choosing how much to put in value versus growth. They're the ones that are choosing the investors. I'm sorry, the managers that they're using. So at the end of the day, it's their responsibility, not ours. And from that standpoint, they continue to underperform. The fact that they didn't underperform as badly as they have in years past, and the fact that we have sort of drawn down the amount that we have invested with them, I'm comfortable with that at this point in time. But, you know, if we were entertaining a discussion about, do we continue to have 4 managers or do we have 3 or whatever, I think then it becomes a little more detailed discussion about them. But overall, at this point, they are what they are. And I guess I keep repeating it, but they didn't kill us last year, but they didn't also overperform either.
Well said, Jim.
Thank you, Jim. Moving on, Fifth Third Bank. You'll see they were one of the lower performers for the last quarter. The Halkasudi Acres Fund was at 5.90 with the benchmark 6.8. And you'll see the Helen Meyer was 6.00, benchmark 6.8. And the same with the Fountain Square Fund was 6.00. And then Levy Clock was 5.68. Then if you scroll to the right, you can see the year to date, going back up top with Sudi Acres, 7.30. And then their 3 years, 2.40. So that's an interesting one where they are actually, they've had the same IPS as such as US Bank, where they weren't utilizing a different one. So there is an indication there that they are not performing as well. And the caveat there is obviously they are the trustee on a lot of these. So we're stuck. Yeah.
Well, yeah, we're stuck, but they also have been very, very responsive to us. And even though they're trustee, I think if we saw this performance continue for another quarter or another 2 quarters, even though they are the trustee, I think as us as the beneficiary and the way that they have treated us, they would be responsive to us if we said, hey guys, this isn't working. What the hell are you doing? Blah, blah, blah. I think they would be responsive. So I don't want to just say we have no influence over it. Just bear in mind, as Craig aptly says, they don't have to do anything we tell them to do. But I think that we should be as critical as we are with them as we are with the other groups. And if they would continue this trend, I think the next time we have them in, we don't feel like we can't express that dissatisfaction.
On a percentage basis of benchmark to actual, they are the rather profoundly worst performing. And I don't, I think we sort of have a rotating schedule. Are they up next or could they be up next?
They could be up next, and I definitely would support that, and definitely with Jim saying, like, all these investment managers are very responsive when we bring them in and speak to them. So I think that would be a great opportunity to bring them in and definitely review what their managers that are selecting to understand why are they underperforming.
Because it's across every time interval that we look at, and you know, it's not to the point where I think it's in violation of fiduciary obligation of the trustee, but it is meaningfully different from the other similarly styled managers. I get why they're different than Ball and Gator because they have a different charge, but their charge and US Bank's charge and PNC's charges are relatively similar, and I think it's a uniform IPS, and I would be interested to call that to their attention and see if they have a reason as to why and a proposed plan. And if they suggest the market has shifted, we need to be doing more fixed income, less securities, I'm all ears. We may or may not choose to advise doing that, but I think if you always do what you always done, you always get what you've always gotten. And what they've always gotten ain't that great. So I'd be anxious to hear a little. I don't so much want to explain the failure as I want to understand the plan to not repeat it.
Yeah,
'Cause that's not-
I would fully agree. That would be, if we can get them in the next time, Craig, I think that would be great.
We meet every 2 months.
It could be every 2 to 3.
Okay.
Yeah.
Is the next meeting on schedule?
No, we'll discuss that towards the end of the meeting today. Okay. Any other questions over the performance report?
I guess just a overall view. Obviously, I think all of them have probably moved up since this point in time. So whether it's an overheated market or not, according to PNC, I do think that we've seen some nice uptick in the market since this point in time.
Okay, next item is the Fountain Square Trust update. Just want to give everybody an update on this trust. It is moving forward through the probate court, and what will occur with this trust is right now it's restricted to the Fountain Square, and once it goes to the probate court, it's going to be semi-restricted to where the remaining dollars could be utilized at Sudi Acres, then any Halk Sudi Acres, and if any remaining dollars from that can then be at any park within the parks districts. So, and the hope there is this trust kicks off between $80,000 to $100,000 annually, and right now we're only utilizing $50,000 to $70,000 depending on the year at Fountain Square. So we'll use the remaining dollars elsewhere.
So the Hawk family was on board.
Yes,
Good enough.
100%.
We meet within November, maybe?
Yes, I think it was. Oh. Uh-oh. There we
We
go.
lose somebody.
We're back.
I'll
We're
just-
back. It was me.
I
actually
just want
hit
to
the mouse.
I just want to say for the committee, Craig's done a very good job with shepherding this with Fifth Third through the system and with their attorneys. So it will be a good benefit for us. And we, at this point, we're just, I think, waiting for a judge to make the final decision and put his stamp on it. But I just want to thank Craig for his diligence in seeing this through. So thanks, Craig.
You're welcome. Just happy to see money go elsewhere where it's needed. Discuss outstanding items and park projects. Jason, would you like to discuss park projects?
I can. You mean just broadly, like what are we up to?
Yeah, usually it's Jim, or since you're here, it's just a broad, like what's going on in the parks, what projects are
Well,
occurring.
Craig and I are actually back early from the Ohio Parks and Recreation Association meeting, which was up in Sandusky this week, where we had a really good time, got to meet a lot of colleagues, got to learn a whole lot about park management throughout the state. We won an award, which is sitting here on the table here, for the second place in natural restoration, natural resources conservation for our efforts to create Walnut Woods of Evanston near Walnut Woods High School, which was a really cool award to get. But gotta get some first places next year. You don't get on stage unless you get a first place.
The judge was the ref from the Kansas City game.
I did. Last minute, we had a block in the back on the president of the organization. But it was nice to get up there and meet folks. There's a ton of history there. There's a lot of folks there that are Parks lifers, and it was neat for me at least how much of our crew. In fact, I think everybody but Ginny, it was their first OPRA, and so I just feel like it's fun that we have a lot of opportunity to really get involved and learn a lot. Lytle Park continues to move forward with that total restoration. We should be seeing Abe Lincoln move here soon in the next week or so, I think. But all the permits are secured. That's moving forward, still on the same schedule. We're getting ready. We started to have some conversations about the path forward with the master plan and what that path is going to look like. We have some scribbling up here on the wall, on the whiteboard, about how we're going to proceed with that. Moving forward with a lot of different projects, whether it's biochar or whether it is the commissioners just passed some funds from various commissioners' funds at the last board meeting to fund a couple of projects. So just things are moving forward really well. We're deep in the budget process, slowly putting together our plans for next year. Things are going well.
Bring it back to what's commissioner's fund. So, I mean, with the investment committee, some of the items that are being funded out of this would be the Burnett Woods Dog Park.
Yep.
Additional fleet needs that obviously with inflation. I believe, John, you were here when I think you were here when we passed that.
That was in October of 21.
Yeah, okay, 21. Well, obviously things went up in price, so we needed additional dollars for fleet needs. We're going to look at increased reimbursement for staffing so we can hire a grant writer. And
learned a lot about grants while we were at OPRA, a whole lot about grants.
There's a lot of grants available out there, especially when you want water involved.
Mm-hmm.
So if we want to start, going towards Ohio River a little bit more, there's a lot of money involved. Then the other one
Speaking
was
of water,
Kevin?
do we have an update on the marina?
Frustratingly, no. So we had a meeting with them last Friday where they presented a ton of different stats about why things are more expensive, which we all know why things are more expensive. We're all living why things are more expensive. But what we asked them to come up with is a plan forward. And so frustratingly, we had a long conversation about a boat that on the sheet, they said has already been sold and isn't available to us anymore. But they were trying to make this case about things being more expensive. They keep coming back to the reason it's more expensive is because of us needing to get the permit, but they don't seem to have a plan forward either. So we're having a meeting next Tuesday. We're having a meeting next Tuesday where we're going to. They left their parking ticket. Anyways, we're meeting next Tuesday where hopefully they're going to present us with some updated drawings and some like a path forward or their preferred path forward. So we shall see.
So I guess my question was the Army Corps of Engineers has signed off on it or not?
They've not signed off on it, but we've got all of the permit needs to them and we're waiting to get, that's moving through its natural process.
Okay, thanks, Jason.
And we're also moving forward with the Army Corps with the stabilization of the river.
Yep.
I'll just jump in here too, as a wrap up with this issue or on this agenda item. It's a new day at Cincinnati Parks. And from a park board commissioner standpoint, I just want the investment committee to know that things are really moving in a positive direction with Cincinnati Parks. And with new staff that we have in place, all the way from Jason on down, working together with staff that have been there for a number of years, we're really working as a team, and it's a positive feeling in Cincinnati Parks, at least from the perception of the commissioners. The work that's being done from a capital standpoint and a maintenance and a repair standpoint this committee has dealt with for the past several years. Do we recommend distributing money out of our investments? Do we recommend keeping money in investments because it's not being put to use? We're at a point in time at the parks today where things are getting done. Resources that we have either from the city, from the foundation, from our own funds, they're being put to use. So I think you're going to be seeing over the next several months, and I know over the course of the next few years, a lot of positive things being done with this money, a lot of improvements to parks, and a lot of chipping away at what we have fondly referred to as deferred maintenance in the parks. We have people that are focusing on getting things repaired, putting back into good condition again. So everything is really moving positively. And I want to give credit to this committee as well. We were sitting around as commissioners looking at opportunities that we had and saying, oh, but where is the money going to come from? Well, as you all know, we have recommended over the past couple of years that we don't distribute money that is available for distribution. And number one, I think it's been the right decision. And then number two, we now have that money available, that if there are things that are available to us or opportunities for the park board to do, we have money available, and we are now tapping into some of those commissioner fund reserves to be able to do the things that we would like to do. So it's a new day, it's a positive, and I want the investment committee to know that the work that they do here with us on a quarterly basis really makes a difference. And I think with your help, now you're going to see those funds really being put to use in some very positive things. And I guarantee that we'll make sure that each of you are invited to ribbon cutting events that will be coming up to see how these funds are being put to use. So I just want to express that to you guys, that it's really a positive thing that we are experiencing with Cincinnati Parks, and to thank you guys for being there over the past several years for helping us steward the money that we have to invest.
Thank you, Jim.
Jim, that's so great to hear. I know since you joined the board of the park commissioners, that's been a frustration on your part, as it was when I was on the board. And it's great to hear with the new team in place that it's all the oars are rowing in the same direction.
Yes. And it's not because Jason's sitting in that room, but I'll express what I have said to others, is you got the right people in the right seats. And I think we've got the right person sitting at the driver's wheel of our bus. So Kevin, Kevin's been intimately involved. John, you've been intimately involved. And I think that you would all be very, very pleased at the direction that we're going. So I'll leave it at that. But Kevin, you're absolutely right. It's a new day.
Well, thank you both. The short version of that, or the summary is that the director is going to be coming with his hand out to these funds in the coming months. So after a couple of years of not taking disbursements, I'm gonna have a list for you guys. So
hey, we're here ready to go. That's what our job is make sure that we've got funding around the place to provide to the park board. So we're ready for you.
And that'll make Susie very happy, Jason. So
I know she's excited every time I ask for money. So
all right. Well, Craig, you want to help us? What are you thinking as far as next meetings?
Well, I would like to target the end of a quarter to give the investment manager the third time to prepare the report. So I'm looking at how would you all feel like April the 26th from our usual time, 3 to 5. Good for me.
Looks good for me.
Because that should give them enough time to get their information together for that first quarter.
Good for me.
can spend a lovely
Good
spring.
for me,
day.
and hopefully I'll be healed by then.
Kevin, I do want to say thank you for participating in this, and hope you're feeling better.
I'm on the mend, but interestingly enough, my wife fell down walking my daughter's dog last week, broke her ankle, and has to have surgery on Friday. So
Oh,
good
no.
for us.
Let's keep on coming.
Weren't for bad luck, you wouldn't have any luck at all.
Gloom
Well, I hope
to
everything goes well on Friday, Kevin.
Yes, yes. Tell Peggy we'll be thinking about her.
Thanks, guys.
Okay, well, we'll set Craig, if you'll get us out a reminder, 26th, that sounds great. And you got anything else, Craig?
I do not.
Motion to adjourn.
Seconded.
No
I think we got
objections. No objections.
Unanimity.
Everybody have a great day.
Thanks, everybody.